Hello and welcome to the Inheritors, the not at all dramatic title for our new series, where we interview the next generation of foreign exchange leaders. My name is Eva Szalay. I'm contributing editor to the Full FX, and instead of Colin, I'm asking the questions in this video series. My victim today is Kimiya Minoukadeh, the head of EFX quant trading at ING. Welcome to the show.
Thank you for having me.
Thank you so much for coming on and for making time. Can we start with a bit of an intro from you, please? Tell us what you're doing at the moment and how you came involved in foreign exchange.
I've been at ING for just over 3 years now, and as you said, heading EFX quant trading. So my team's role is really to come up with the pricing, risk management and analytics models for the whole suite of FX products. So covering everything from spot, NDFs, and more recently swaps and options as well.
And is it for clients and as well as internal facing?
Yeah, so we have internal clients, but primarily very client focused. We're the market making business.
And you guys must have a lot of corporate clients.
Yes, indeed.
So
indeed.
Can you tell us a little bit about, what are the kind of things that clients were asking from you guys? What are the kind of things that you're currently focusing on as a team?
Sure. So I think from corporates, really more and more, I think transparency is what our clients are asking for. So both pre-trade and post-trade analysis. We're getting a lot of requests for TCA, whether they want to run algos, and even for the transactions they do with us, they want to have a good color on what they can, what sort of pricing they can achieve. We've seen over the decades, obviously, what would have been about 90% voice traded 20 years ago now is electronically traded. And so really this sort of seamless trading is really what they expect. And even at ING over the past, I'd say 3 years, what's electronically priced and risk managed on the spot side, for example, we have doubled or tripled in some cases. So I think that's the direction it's going to go. That's what people expect, lower touch trading, but also where I'd say on request, having more of that sales interaction and market color.
It's really interesting. The double or triple. That's a big increase,
yeah.
Right? Can you tell us a little bit about which areas? Is it the execution that's mostly been electronified? Is it other areas? I imagine data is quite important nowadays.
Yeah, that's true. So especially, so when I joined 3 years ago, I did join as the first quant in the team. They had a big digitalization initiative. So I was the first quant to join, and now we have a whole team doing that. And actually, exactly when I joined, the rest of the team were just getting all the data in a nice, say, readable or structured format. So I came at a really good time to be able to really dig into it. And the first things that we did look at not only was latency, but really managing impact. So that is the main thing that's allowed us quite quickly early on to increase sizes, and more recently to really risk manage everything that we electronically price as well. So it is exactly, as you said, risk management, managing market impact, that it is the data obviously that allows us to then really drill into where we can hedge out much more slowly and reduce impact where possible.
And I guess with automating the kind of low touch stuff, you've got more time as a team to sort of deal with the more complex, more interesting stuff.
Yeah, exactly. And so that's why our focus this year has really turned to NDFs and swaps. People maybe have different opinions on this, but everything that we have done in the spot market, I think, both in terms of the number of venues, the sophistication of clients, the availability of market data has really given FX or FX spot. We're in a privileged position to be able to analyze the data and to be able to know how to tackle specific problems that we see, and that we're applying directly to NDFs and swaps as well as we go.
I imagine that's something that's ticked up over the years quite significantly.
Yeah, it has.
And you expect that to
hopefully increase as well. We'll talk about the challenges of assessing real liquidity in the markets, but given we can have a confident assessment of what we can get in the market, I think we can increase that yeah, I think that's what clients expect, and we should be able to do as well.
Yeah, there's it's a long way from 1 million trades, right?
Yeah.
Okay. So NDFs and swaps is a really interesting area, right? There's been a lot of talk about, especially around swaps, that they're quite slow to kind of move onto electronic venues. Can you, tell us a little bit about how you see that world evolving?
Yeah, so I find it really interesting because there's still a lot of trader knowledge, input, intuition needed in this world, and if you speak or ask people on the street, I think people do say they have an electronic swaps offering, and often that is more on the pricing side. So obviously when we talk about electronification of certain products, one side is pricing to clients, and the majority of products within FX are now electronically priced. But then comes the question of electronically risk managing. And again, if that risk management, if you have a high internalization rate and you can just show an axe to your clients and get out of that risk, that's also through pricing alone you're able to manage that risk. But I think the piece that's missing to go to really, I don't want to say reproduce the spot model, but go in the direction that spot has, we need some electronic venues for swaps as well. So there has been, and last year ING did the first trade on 360T Sun, which is the API for the swap CCN. So we're currently using that, and we're active on there, and we are hoping that that really picks up, because I think other than pricing and skewing and showing an axe to clients, we need an electronic venue like this to really kick things off.
It's so interesting, isn't it, to kind of, because it felt like volumes were picking up a little and then they kind of fell back down, and it feels like the market is quite sort of reluctant in a way, like to move in that direction. And why do you think it is, or do you have any take?
I mean, I do think the nature of the market is quite different, but I do also think that it's inevitable that it would move.
It's very hard to see a different outcome, right? It's very hard just to kind of put the genie back in the bottle. And one of the things that, I guess there's so much talk about at the moment is things like data and how all that feeds into the market structure changes.
Yeah.
So in terms of like big themes and key trends, what's your take? What do you think is interesting? And how do you see the sort of zooming out, the overall market changing?
So I think other than electronification of NDFs and swaps that we've discussed, I think the two areas that is definitely in discussion and does face bank market makers, does pose a challenge, is the new principal market makers on these ever-increasing number of trading venues as well. Because coming back to what we discussed about managing market impact, measuring market impact, controlling it, to be able to give our clients the best bid-offer spreads, the best liquidity, we need to be able to manage the impact that we have in the market. Now, again, about 10, 15 years ago, that was just about, okay, we internalize, we don't hit the external venues as much, and that was enough maybe to manage market impact. So I think those two coupled together is something that is a constant conversation that keeps both the quant work really interesting, but also managing all of those relationships and venues. That's what also needs good sales input as well, because just understanding how all the clients are both consuming, trading in the markets as well, that does take a lot of time, and that's why there's more and more need for sales as well these days.
They'll be happy to hear that. They'll be happy to hear that, I'm sure. It's so interesting that you mentioned that sort of circularity in terms of outcomes and liquidity, and it sounds like it's still quite a big issue, or quite a big sort of puzzle to solve. Do you see that persisting? Do you think that the fragmentation and fragmentation of liquidity providers is still going to get worse, or? more or bigger?
It's a good question. I don't know, because as we talk about it, the reason why it's happened is because there's probably a lower barrier to entry. Yeah. And again, just as for our clients, I mean, that's a great thing that people can trade on their chosen venue. They can trade faster and quicker and larger sizes as they wish. So, but all of that means that there are all of these players, and it's just become difficult to manage. So things like, there are some venues who've imposed the FX Global Code, and the players on there should adhere to a certain guideline. And I think, ideas like that aren't bad, to maybe not slow things down with hard regulation, but things like guidelines and good practices. I think for the ecosystem, it's probably a good thing to make sure people are behaving.
And also some transparency, right, about what people are doing.
Yeah, that too, of course.
Because it's kind of strange to think that, I remember calling the FCA like 15 years ago and asking them, who's regulating this market, and they were like, well, not us. So it's ultimately the market participants who have to set these standards and these rules. Do you think there are any issues in the market that the market should look at, or the industry should look at, or any kind of problem areas, maybe around liquidity or anything else?
Yeah, I mean, I think nothing other than what I mentioned. So it is more whether we stop that from happening or learn to measure it better. Because again, going back to liquidity, it's known also that the trading or the volumes on the primary markets have really reduced significantly. Yeah. But because there are probably the same liquidity providers on these many new ECNs or secondary ECNs, and if everybody is pricing exactly the same price, then as soon as there's a bit of market disruption, that all disappears, or it's sort of mirrored liquidity. So in terms of, again, knowing, is there really 50 million liquidity in the market, but actually, if you start trading with one name, then all of that disappears. That just becomes really difficult to manage. So whether it's measuring that correctly and just, saying, well, this is the new world that we live in, because ultimately, as long as we can measure it, we can work around it. So I think it is more, potentially, it could be working with it rather than necessarily treating it as a problem.
It's just a new reality.
It's a new reality, yeah, at least for some time, because I don't know who will solve that problem. But so, I mean, it's an interesting one as well, again, from our models. And for many years, people have tried to detect that to improve both their own risk management, but also experience for clients. And even that is becoming harder and harder to do. So it's still point of discussion.
It sounds like you've got a lot of interesting sort of questions to look at. And what about you mentioned briefly about the clubs and how activity on these once mighty venues has declined. Let me ask you about, because I forgot at the beginning to ask how you came to be in foreign exchange. How did you get involved with it?
Sure. So my background actually started in academia. So I did my undergrad is in maths and computer science, and I went on to complete a PhD in applied maths, but it wasn't applied to financial markets. So it was molecular simulation or protein folding. So it was at that time, anybody, my circle of friends with PhD in applied maths, and this was 13, 14 years ago, they ended up working in finance. So through that, I started having multiple interviews for quant roles, and it was actually just through interviewing for electronic trading or quant trading roles, through the types of questions they were asking and the sort of the pace of the questions and the dynamic nature of it, I just really liked it. So that's how I started my career. So I started in the electronic market making desk, again FX, spot and options at UBS. Okay. So I was there for 10 years and then joined ING after that.
Fantastic. So it sounds like you're way too smart for FX.
For quant trading.
Exactly, for FX quant trading. I was going to ask you about outages and sort of, there is like this old school thought, I guess, that, in my days, trading was like, we knew how to take risk, and we were like proper risk takers and proper traders, and nowadays it's everyone just pressing buttons. What do you think of that? And also, how do you guys deal with sort of having to rely on such an electronic market structure? What happens when there is an outage? How are you able to handle that?
I see. Well, I have to say, in terms of taking on positions or holding on to larger positions, if anything, I think the e-trading systems have an advantage because we're able to, when markets move quickly, we're able to react quickly as well, whereas a human, for example, might not. And in terms of, again, if there's market outages, I mean, so far nothing comes to mind that has been really disruptive in that sense. There's been big market movements, and that as well, I think, again, as long as you sort of stay within your risk limits, if there are some losses, I think it's expected. So I think, again, those are the sorts of things that we can code in and automate, and there's sort of less space for error, and that's one of the reasons that we started to actually electronically also risk manage everything that we price electronically, because we have all of these controls in place. And equally, in terms of us, for example, not taking on further risk, we have a number of controls in place to, whether it's to stop pricing or stop hedging when there's real disruption in the market. All of that is automated as well.
It's so interesting that FX has done so well, actually. Like, the kind of outage question is really not, I can't think of an example.
Yeah, I have to say.
The last one is like, I used to get excited about, writing about an EBS outage or a writer's outage, back in the old days, and that had a big impact, right?
Yes, exactly.
But now it's
and so, I mean, that's probably, of the things that we discussed, probably one positive, that there are really a number of venues now that you can get liquidity. So we're no longer reliant on one particular. Again, as we said, if we do trade, there's a lot of mirrored liquidity, but ultimately there's lots of different players out there, lots of different venues. So at least nothing comes to mind that, where everything is completely wiped out. Yes, there's been big market moves or gaps in the market, and that could cause a loss to P&L, but there's been nothing that's been that shocking.
No disasters, right? Like FX has been quite sort of steady and dealing with quite a lot of volatility, and the sort of rate hikes in the last few years, and in fact it used to be a little bit too boring, right?
Exactly.
How do you see the market changing going forward? What are the kind of interesting things that you think might happen? Maybe on your patch, in terms of the quant world, or in terms of the broader market?
Yeah, so I think, again, the sort of specific products we've discussed, but I think in our world especially, we have to talk about AI. We can't not.
It's the magic word.
It's the magic word. And in our team, ING, we're actually about to go live with our first AI model. And I think in context of this whole conversation, it is actually what I thought was sort of a good, nice to have, or a sort of cutting edge model to have in place. I actually think with everything we've discussed and the way the world is moving ever so quickly and ever so difficult to keep up with, I think AI is going to become a bit of a necessity. And by that I mean not only being able to handle and dissect and analyze large amounts of data, but also, being a bit more explorative in how they approach modeling. So far, in FX, again, because we've been so blessed with so much market data. We've had a lot of market data, and obviously the traditional modeling is sort of fitting a model to what you've seen in the past, right? And it's quite easy to do. It's what we've done all, and that's where in FX has done so well in electronifying the market versus some of the other asset classes or rates and credit, for example. It's just the availability of market data, and we can take a model, we fit it to what we've seen. But with things moving so quickly, I think AI is just going to be a necessity as well moving forward, because we can't just tell it, just do what you've done in the past. It has to evolve. It has to learn from new data itself. So I think just with the way things are moving, we're going to see more and more of that.
Is there anything that you think FX could learn from, say, equities or other markets that might be beneficial?
Nothing comes to mind.
Nothing comes to mind. FX is totally leading
I
away.
didn't think about that one. I might have to come back.
No, that's a good answer. It's an FX publication. We love the answer. And finally, before I let you go, can you tell us a bit about, whether your future, is it in FX? Do you think that this is a long-term career plan for you? Is it do you have any areas that you think you might want to get into?
Yeah, I mean, it's a good follow-up question, because I think in terms of personal, say, plan for the next few years, I do think this cross-asset collaboration is really exciting. Again, we've started those conversations internally already, and we have the quant working groups already across the asset classes. So that, I think there's definitely scope to grow and learn there. Both of the spaces are moving very quickly. And for me, again, touching on the AI space, which is really growing, with my academic background, I also just really want to strengthen the academic partnerships that we have at ING. So this year, we're actually just completing the first round of MSc internships. So these are from a number of institutions or universities. We've had students come to complete their master's thesis with us, which means they would have an industry supervisor such as myself and an academic supervisor, and they're able to work on problems that we're looking, but equally we get the latest research available from these universities in these new growing sort of machine learning AI spaces. So those for me, both cross-asset growth and academic ties, I think will really keep me busy for the next foreseeable future. So.
That sounds great, especially because I always feel that with foreign exchange, there's just, it's not really part of like the business degrees. You learn about equities, and you learn about how important equity market structure is, and foreign exchange is just kind of like it's
almost a necessity.
Also.
But for international
don't worry
trade
too much about it, right?
That's very true. All the examples, even in academia, they're always equities. So maybe that's also a personal ambition to change that.
There you go. That would be brilliant. I think there would be so much more understanding generally, I think, of FX if people heard about it a little bit sooner. So that's great to hear.
Yeah.
Is there anything else that you wanted to touch on or mention today that we haven't talked about?
I don't think so. I might check my notes, but I think that's fine.
That's wonderful.
Yeah.
Well, thank you so much for making time. It's a pleasure to have you.
Thank you for having me.
Thank you.